The hidden wealth transfer coming for 47 million Americans in the next 30 days. If you depend on retirement savings, collect monthly benefits, or still owe money on your house, the next 4 weeks will determine whether you preserve your wealth or watch it silently vanish over the next decade. What's about to unfold has happened only once before in American history, and almost no one saw it coming then either. On May 15th, 2026, a major shift occurs in how the United States manages its crushing debt burden. The mechanism being activated is the same one used between 1946 and 1974 to eliminate two-thirds of federal obligations, without Congress ever voting to pay down a single dollar of principal. During those 28 years, savers who followed conventional financial wisdom lost approximately 40% of their purchasing power, while borrowers with fixed rate obligations saw their real debt burden cut in half. The phrase that signals this shift appeared twice in recent Senate testimony. That phrase had not been used in any official federal communication in over 4 decades. The phrase is financial repression. And if you don't understand what it means, you are about to become significantly poorer without ever seeing a number go down on any statement you receive. Financial repression is the deliberate suppression of interest rates paid to savers below the actual rate of inflation, forcing depositors to lose purchasing power year after year, while the government and all holders of fixed rate debt watch their real obligations shrink automatically. This is not theory. This is not prediction. This is documented historical policy that worked exactly as designed for nearly 3 decades and is now being reactivated because the federal balance sheet has reached a level that cannot be addressed through any other politically viable method. The people who will lose the most are not the ones with the smallest savings. The people who will lose the most are the ones who spent the last 40 years doing exactly what every mainstream financial expert told them to do: eliminating all debt as quickly as possible, keeping emergency funds in federally insured bank accounts, and building retirement portfolios around safe long-term bonds. Every single one of those decisions is about to become a structurally losing position for the next 10 years. The people who will benefit are the ones holding the exact assets that Financial Advisors USA Senior Guide been telling retirees to eliminate: fixed rate mortgages at any rate below 5.5%, inflation index securities that most investors have never even heard of, and hard assets that generate income streams tied to real world price increases rather than nominal dollar amounts. In the next several minutes, you will learn the 4 specific moves to make immediately, the 3 retirement asset categories that get destroyed under this framework that you almost certainly hold right now, the one government backed instrument that 94% of retirees are eligible to purchase, but fewer than 8% actually own, and the single decision that turns a recoverable position into a permanent, irreversible loss of retirement purchasing power: the hidden inflation tax that destroyed savings. From 1946 to 1974, between 1946 and 1974, the United States faced a problem structurally identical to the one it faces today. Federal debt had reached 121% of gross domestic product following World War II. There were only 4 realistic options to address it: explicit default, massive tax increases, severe spending cuts, or a hidden transfer of wealth from savers to borrowers through sustained negative real interest rates. The government chose the fourth option because it was the only one that did not require a congressional vote and did not generate visible political backlash. The mechanism was simple: keep the interest rate paid on government bonds and federally insured bank deposits below the actual inflation rate for as long as necessary to erode the real value of outstanding debt. A saver who deposited $10,000 in 1946 into the safest possible instrument, a federally insured bank account, received approximately 1.5% annual interest, while actual inflation ran between 3% and 6% annually. By 1974, that original $10,000 deposit had grown to approximately $14,700 in nominal terms, but had purchasing power equivalent to only $6,200 in 1946. The saver lost 38% of their wealth while doing exactly what the government and every financial institution told them was the safest, most responsible decision. During the exact same period, a borrower who took out a 30-year fixed-rate mortgage in 1946 at 4% saw the real value of their outstanding principal fall by approximately 60% by 1974. They repaid the loan in dollars that were worth a fraction of what they borrowed, and the lender absorbed the loss. The federal government was the single largest beneficiary. Debt that stood at 121% of GDP in 1946 fell to 31% by 1974 without a single year of budget surplus large enough to pay down the principal. The entire reduction came from inflation eroding the real value of outstanding obligations, while nominal interest rates remained suppressed below the inflation rate. This is financial repression. It is not a collapse. It is not hyperinflation. It is not a stock market crash. It is a slow, steady, deliberate transfer of wealth from savers to borrowers that happens silently over years and is almost impossible to detect unless you know exactly what to look for. Disc from the three categories of retirees who lose everything. Category 1, the cash saver. Patricia is 72 years old. She lives in a modest condominium that she paid off completely in 2015. She receives $2,490 per month in Social Security benefits plus a small pension. After her husband passed away, she combined his life insurance payout and proceeds from the sale of a vacation property into a single federally insured savings account. The current balance is $81,642. Her account pays 4.2%, 2% annual interest, which sounds reasonable until you examine the actual inflation rate that affects retirees. The headline Consumer Price Index over the last 12 months ran at 3.1%. But the Consumer Price Index for elderly Americans, calculated separately by the Bureau of Labor Statistics to account for medical expenses and housing as a higher share of household spending, ran at 5.7% over the same period. Patricia's real return after adjusting for the costs that actually affect her household was negative 1.5%. She lost approximately $1,124 in purchasing power last year, and it did not show up on any statement she received. Her financial advisor did not call her. She had no mechanism to know unless she went looking for the alternative inflation series herself. Under the framework now being implemented, that negative 1.5% annual real return becomes the design target for the next 10 years by explicit policy. The Federal Reserve and the Treasury Department will coordinate to keep nominal interest rates on government debt and on federally insured bank deposits below the actual rate of inflation. Patricia's $81,642 in cash is structurally a losing position, and she cannot escape by switching banks or finding a higher yield account. Every federally insured savings instrument is subject to the same nominal rate suppression. The escape requires moving that cash to a different category of asset that the framework does not target. Over the next 10 years, if inflation averages 5.5% annually, and her savings account continues to pay 4.2%, 2%. Patricia will lose approximately $27,000 in real purchasing power from that single account alone. Category 2, the mortgage accelerator. Robert is 67 years old and lives outside Phoenix, Arizona. He receives $2.3 per month in Social Security benefits, a small disability check, and carries a 30-year fixed-rate mortgage from 2021 at 3.2%. The remaining principal is approximately $140,000. Under conventional financial advice, Robert has been making extra principal payments of $200 per month for the last 4 years to retire the mortgage early and eliminate all debt before he reaches age 75. Under financial repression, Robert's mortgage is the single best asset he owns, and every extra principal payment is a voluntary transfer of his own purchasing power into the bank's balance sheet. If inflation runs at an average of 5% over the next 10 years and his mortgage rate remains fixed at 3.2%, the real value of his outstanding principal falls by approximately $50,000 simply by holding the debt and making only the minimum required payments. Every extra dollar Robert pays above his minimum monthly obligation eliminates this structural advantage. The $200 per month he has been sending to the bank could instead be redirected to inflation-protected instruments that preserve purchasing power. The mortgage interest deduction also becomes more valuable in real terms as inflation rises because the deduction is calculated on the nominal interest paid, while the real cost of that interest falls as inflation accelerates. Category 3, the conservative bondholder. David is 69 years old and lives outside Chicago. He receives $2 to $10 per month in Social Security and holds approximately $190,000 in a portfolio concentrated in 20-year and 30-year Treasury bonds. His advisor recommended this structure as the safest possible allocation for a retiree who cannot afford to lose principal under financial repression. Long-duration fixed income is the asset category that loses the most, and David's portfolio is positioned for maximum damage. As inflation runs above the bond yield, every coupon payment David receives buys less in real terms. As the framework persists, the market price of his existing bonds falls if he ever needs to sell before maturity. The real return on David's bond portfolio will be mathematically engineered to run at 2% to 4% per year over the next decade. Over 10 years, his $190,000 portfolio could lose between $60,000 and $95,000 in real purchasing power, even as the nominal balance remains stable or grows slightly. The advice that worked for retirees in the 1980s and 1990s becomes the worst possible advice under the framework now being implemented. During the 1980s and 1990s, the Federal Reserve fought inflation by keeping interest rates high, which rewarded savers and punished borrowers. That framework is now reversed, and almost no one in the financial advisory industry has adjusted their recommendations. To Caro, the 4 moves to make in the next 30 days. Move 1, audit your fixed income exposure. Pull every retirement bank and brokerage statement you currently hold. Write down the total dollar amount you have in cash savings accounts, certificates of deposit, money market funds, short duration treasury notes, intermediate treasury notes, long duration treasury bonds, corporate bonds, bond mutual funds, and any pension or annuity with a fixed monthly payment that does not adjust for inflation. Add those numbers together. That total is your fixed income exposure. For the typical retiree, that number represents between 60% and 90% of total retirement assets. Under financial repression, that entire allocation is structurally engineered to lose real value year after year. This audit takes approximately 15 minutes and costs nothing. Move 2, stop accelerating mortgage payoff. If you currently hold a fixed rate mortgage at any interest rate below 5.5%, immediately stop making any payment above the minimum required monthly amount, reset your payment to the contractual minimum, and redirect the difference to a different category of asset. The fixed rate mortgage is the only common debt instrument structurally engineered to benefit the borrower under financial repression. If your mortgage rate is 3.5% and inflation runs at an average of 5.5% for the next 8 years, the real value of your outstanding principal declines by approximately 35% simply by making minimum payments and allowing inflation to erode the debt. For most retirees, the mortgage is an asset, not a liability for the next decade. Move 3, move fixed income to inflation-indexed instruments. The 2 instruments available to retail investors that provide explicit inflation protection are Series 1 savings bonds, commonly called I-bonds, and Treasury Inflation Protected Securities, commonly called TIPS. I-bonds are purchased directly through the Treasury Department website. They adjust their interest rate every 6 months based on the official Consumer Price Index. The interest is exempt from state and local income tax. The annual purchase limit on I-bonds is $10,000 per person electronically, plus an additional $5,000 if you elect to receive your federal tax refund in paper form. A married couple can therefore move $30,000 per year from low real return savings accounts into inflation-indexed instruments. TIPS are purchased through the Treasury website or through any brokerage account. They adjust their principal value semi-annually based on the Consumer Price Index. TIPS are available in maturities of 5, 10, and 30 years. And unlike I-bonds, there is no annual purchase limit. For retirees with significant fixed income exposure, the sequence is to max out E-bond purchases first because the tax exemptions make them more tax efficient than TIPS for most households. After reaching the annual E-bond limit, additional funds should be moved into TIPS with maturities that match your expected liquidity needs. A 70-year-old retiree with $150,000 in certificates of deposit should immediately move $10,000 into I-bonds. And if married, the spouse should do the same. The remaining $130,000 should be repositioned into a TIPS ladder with maturities spread across 5, 10, and 15 years. Move 4, verify pension inflation adjustment. Social Security adjusts automatically every year based on the Consumer Price Index. That adjustment is statutorily protected and cannot be eliminated without an act of Congress. Most pensions, including the overwhelming majority of corporate pensions and many state and local government pensions, do not include automatic inflation adjustments. If your pension lacks an adjustment, the real purchasing power of your monthly benefit will decline every single year for the rest of your life. A pension that pays $1,500 per month today with no inflation adjustment will have purchasing power equivalent to only $900 per month in 10 years. If inflation averages 5% annually, call your pension administrator and ask one specific question. Is my benefit adjusted annually for inflation? And if so, by what index? If your pension has no inflation adjustment, it is functionally identical to a long duration bond, and you need to build additional inflation protection elsewhere in your portfolio. The tax strategy 94% of retirees miss: completely internal revenue code. Section 135 provides a federal income tax exemption on interest paid by Series 1 savings bonds when the bonds are used to pay qualified higher education expenses for the bondholder, their spouse, or a dependent. For retirees with grandchildren approaching college age, this is the most tax efficient transfer of inflation hedged wealth between generations available to any American household. You purchase I bonds in your own name or jointly with your spouse. You hold those bonds until your grandchild is approaching college. When the grandchild enters college, you redeem the bonds and use the proceeds to pay qualified tuition and fees directly to the educational institution. The interest that occurred during the holding period, which under financial repression will likely run at 5% to 7% annually for the next decade, is completely exempt from federal income tax. It is already exempt from state and local income tax regardless of how the bonds are used. For a married couple with $60,000 in combined Social Security and pension income, this exemption is available in full. If they purchase $10,000 in e-bonds each year for 10 years, and those bonds grow to $190,000 due to inflation adjustments, the entire $90,000 in accumulated interest can be withdrawn tax-free if used for qualified education expenses. No other common investment vehicle offers federal tax exemption on interest income for middle-income households. Thus, the one mistake that turns recoverable losses into permanent destruction. The single worst decision a retiree can make under financial repression is to panic sell long-duration bonds or bond funds in a taxable account during a period of falling bond prices without understanding the tax consequences and without repositioning into inflation-protected alternatives. As inflation rises and the Federal Reserve allows interest rates to drift upward slightly, the market value of existing long-duration bonds falls. A 30-year Treasury bond issued in 2023 at a 4% yield will trade at a significant discount if new 30-year bonds are issued in 2027 at a 5.5% yield. A retiree holding $100,000 in a long-duration bond fund sees their account balance drop to $85,000. They panic and sell, locking in a $15,000 loss. They now have $85,000 in cash sitting in a money market account earning 4% while inflation runs at 5.5%. They have converted a bond position that was losing real value slowly into a cash position that loses real value at exactly the same rate while also triggering a taxable event. The correct sequence is to sell long-duration bond positions in tax-advantaged accounts first, where capital losses do not create taxable events, and immediately reinvest the proceeds into inflation-protected securities. In taxable accounts, long-duration bond positions should be sold in stages across multiple calendar years to manage capital gains and losses, and proceeds should be immediately moved into TIPS or I bonds rather than sitting in cash. The difference between executing the sequence correctly and executing it incorrectly can represent $40,000 to $80,000 in purchasing power over a 10-year period for a retiree with a $200,000 portfolio. What happens on May 15th, 2026? The formal implementation of the new framework begins with coordinated policy announcements from the Federal Reserve, the Treasury Department, and key regulatory agencies. These announcements will not use the phrase financial repression because that phrase carries negative connotations. Instead, the language will emphasize economic stability, sustainable growth, and ensuring that interest rates remain at levels that support employment and investment. The actual mechanism will be a commitment to purchase government securities in quantities sufficient to prevent yields from rising above a specified target range. The political cost of financial repression is nearly zero because the losses are diffused across millions of individual savers and occur slowly enough that most people never identify the cause. A retiree who loses $30,000 in purchasing power over 10 years sees their account balance grow in nominal terms and assumes they are doing fine. The 30-day window. The reason the next 30 days matter is that once the framework is formally announced and implemented, the market for inflation-protected securities will adjust immediately. TIPS yields will fall as institutional investors rush to reposition, and bond purchase limits will prevent most households from moving significant sums quickly. Right now, before the formal announcement, TIPS are available at yields that still provide meaningful real returns, and I-bonds can be purchased at current rates without competing against a surge of institutional demand. A retiree who waits until June to begin repositioning will find TIPS yielding 0.5% to 1% less than they yield today, which over a 10-year holding period represents a loss of $8,000 to $15,000 per 100,000 invested. The people who reposition in the next 4 weeks will lock in inflation protection at the most favorable terms available. Guard the 4 categories of assets under financial repression: losing assets, cash and federally insured savings accounts, certificates of deposit, money market funds, treasury notes, treasury bonds, corporate bonds, bond mutual funds, and any pension or annuity with a fixed monthly payment that does not adjust for inflation. Winning assets, fixed-rate mortgages at any rate below 5.5%. Series 1 savings bonds, Treasury inflation-protected securities, real estate that generates rental income indexed to inflation, and equity positions in companies with pricing power sufficient to pass cost increases to customers. Protected assets, Social Security benefits, inflation-indexed pensions, inflation-indexed annuities, and deferred compensation agreements with cost of living adjustments tied to the Consumer Price Index. The historical reality everyone ignores. Between 1946 and 1951, the Federal Reserve maintained a policy of capping Treasury yields at 2.5% for long-term bonds, while inflation ran between 3% and 8% annually. During those 9 years, savers holding government bonds lost approximately 25% of their purchasing power, while the federal government reduced its debt burden by an equivalent amount in real terms. The current situation differs in one critical respect. The post-war period featured a young population entering peak earning years. The current period features an aging population entering retirement with declining labor force participation. This means the economic growth that partially offset the negative effects of financial repression in the 1950s will not be present to the same degree in the 2026 to 2036 period. The losses to savers will be more severe because retirees cannot increase their labor income to compensate for purchasing power losses. What to do right now? First, complete the fixed income audit. You must know your exact exposure before you can reposition effectively. Second, stop any accelerated mortgage payments immediately and redirect that cash flow to I-bonds or TIPS. Third, open a Treasury Direct account if you do not already have one. The account setup process takes approximately 20 minutes and requires your Social Security number, bank account information, and a mailing address. Fourth, max out I-bond purchases for yourself and your spouse if married. Fifth, reposition long-duration bond holdings to TIPS or short-duration bonds in stages across the next 90 days. Sixth, verify your pension's inflation adjustment status by calling the administrator directly. Seventh, if you discover your pension has no inflation adjustment, calculate the purchasing power loss you will experience over the next 10 years and build a compensating position in inflation-protected securities. Eighth, if you are currently working with a financial advisor, schedule a meeting specifically to discuss financial repression tips and I-bonds. If your advisor dismisses the topic, find a different advisor. The next 30 days are not the only opportunity to act, but they are the window where the terms are most favorable. Every week you delay reduces the benefit you can capture and increases the cost of protection. If you found this information valuable, share it with one person who needs it. The difference between acting now and acting 6 months from now could represent 5 years of financial security and retirement.